Well, good morning, everyone, and welcome along to this National Institute for Economic and Social Research and University of Glasgow webinar. I'm Graham Roy, and I'm Dean of External Engagement here at the College of Social Sciences at the University of Glasgow. And we're delighted that you're joining us today for this new webinar series that we're launching with the National Institute, where we've had a partnership with the National Institute for Economic and Social Research for just over a year now. And part of our aim is to try and bring the expertise of the National Institute to the Scottish economic context, and that's part of what we're going to be doing today. And the National Institute have this partnership with the University of Glasgow and also colleagues at the University of Cardiff too. So over the coming year, we'll be rolling out a series of workshops both here in Scotland and in Wales too. The purpose of today is to look at the latest economic outlook and economic context. And for that, we'll be hearing from a couple of different presenters talking about the global context, then looking at the UK context and what does that mean at a regional context. So to discuss the Scottish aspect of that, I'm delighted that Professor Ronnie MacDonald will join me for a conversation in the second part of the webinar. But first up, delighted that we're going to be joined by Kimar White, who's going to talk about the global context, and then Arnar Bhattacharya, who's going to talk a bit about the UK context, and then the regional element too. We're delighted that this webinar is part of the ESRC's Festival of Social Sciences. So at the end of the webinar, we'll be asking you to complete a questionnaire as part of the festival to get your feedback on this event and future events that will be running. So without further ado, I'll ask Kimar to share his slides and to talk us through the global economic outlook. We'll be doing the usual Q&A part of the webinar at the end of the session. So if you've got a question, please fire it into the Q&A part of it, and we'll do our best to get around as many questions as we can. So Kimar, over to you. Welcome along.
Thank you, Graham. So good morning, and thank you again, Graham. Good morning, and thank you for joining this webinar jointly hosted by University of Glasgow and the National Institute. My name is Kimar White, and I'll be just speaking briefly on our recently published Global Economic Outlook at the Institute. So we use our global macroeconomic model, NIESR, to run the forecast, and I'd like to thank my colleagues whose names are listed on screen here. So the global economy is still recovering from the pandemic shock, but at a slower pace than we expected 3 months ago. Our headline is that we have revised down our projection for global GDP growth by about 0.1% this year. We have also revised down our outlook for next year to 4.3% from 4.5%. and to 3.7% in 2022. So the downgrade reflects developments in inflation, which is growing more strongly than we expected 3 months ago, as the virus continues to crimp global economic activity and severe supply chain disruptions hold back the recovery process. There is still considerable heterogeneity in the recovery process across countries among advanced and emerging economies, particularly as we see faltering vaccination rates in some parts of the world. So for example, we're seeing in advanced economy where vaccination rates are almost 20 times faster than those in the emerging market economies. As a result of supply side disruptions, rather, we've revised down world trade growth to 8.3% this year and 7.6% next year. Our OECD consumer price inflation is forecast at 3.2% until 2022, which we're expecting to moderate to 2.6% in 2023 and remaining above the rate seen before the pandemic. At the sector level, current procurement problems for raw materials and intermediate goods are putting the brakes on the global economy. Manufacturing in developed economies risk facing a bottleneck recession. This chart, as you can see on the right-hand side here, simply shows the percentage of respondents reporting supply chain disruptions in the US by specific sectors. Such falls are already happening in numerous industries, as you can see, most notably in the automobile industry. where a chip scarcity is causing a production slowdown. Now, supply chain disruptions arose throughout the pandemic, and they peaked in early 2020 and built up again during 2021 as more permanent reopening added to increased demand for a wide range of goods and commodities. Now, these curtailments will feed, of course, into lower real GDP figures over the next few quarters, slowing down the economic recovery in the process. Now, our inflation forecasts are higher than our previous forecast 3 months ago. As demand has increased and growth in some countries, especially in the US, has been rapid, excuse me, commodity prices have risen sharply. And of course, with supply chain disruptions, input and consumer prices have also risen. In the US, those developments have pushed 12-month core personal consumption expenditure, the so-called PCE, to its highest level since 1991, standing at about 3.6% now. Now, all eyes are, of course, now on how persistent inflation will be and how central banks in advanced economies will react. Now, we examine the US monthly price changes in box A. So this is box A in our global economic outlook, which you are very welcome to have a look at in our recent publication. Now, following the work of one of our colleagues, Hugh Dixon, what colleagues here at the Institute have looked at is they've made stylized assumptions about future monthly price changes to derive possible paths for annual inflation over the next 18 months. So the first assumption is that monthly price inflation returns gradually to change to average level over the next 5 years before the pandemic. And this is shown as the return to past inflation, as you can see here. The second assumption is that inflation adjusts back to a higher rate, assumed to be twice that of the pre-pandemic average. And the third assumption is that we assume that monthly price inflation continues at the same rate as in September, and this is of course labeled as 0.3% a month in the figure. Now, the implied paths for year-on-year inflation in the figure show that year-on-year inflation continues strongly for the next few months, hitting about 5%. So year-on-year inflation only returned to 2% at the end of next year. If monthly inflation remains at 0.3% a month, then year-on-year, we project inflation will remain stubbornly close to 4%. Now, we have downgraded our forecast for the US economy, which is now projected to grow by 5.8% this year and 3.7% next year. Supply constraints are affecting the euro area, of course, particularly as economies most reliant on global supply chains, such as Germany, tending to slow down. But even with this, euro area GDP growth is now forecast at 4.8% this year. And this is thanks to expected rebound, of course, in large economies such as France, Spain, and Italy. And we're expecting at about 4% in 2022. Now, there is a divergence in economic growth performance within emerging economies between fast-growing China and India, for example, on the one hand, and other emerging economies, whose growth patterns are more exposed to cyclical demand swings in advanced economies on the other hand. China's economic prospects have been the most promising among the big emerging market economies since the pandemic, although news from China remains quite mixed. India, of course, as you know, as many institutions have projected, is still on track to achieve the world's fastest growth this year. And that's thanks to a still strong manufacturing and service sector performance. Economic activity is expected to recover its pre-COVID levels not much earlier than we envisaged in our summer forecast. So in terms of regaining pre-pandemic level of GDP, China and the US have already done so, but the euro area is not expected to regain its pre-pandemic GDP level until late 2022. For 2025, we project global GDP to be 2% lower than expected before the pandemic. And that corresponds to a cumulative loss of GDP relative to expected by about 2025 at around 25 trillion. Of course, there are risks to any forecast, and there are risks that we've considered to our forecast. So the first sort of risk we consider, the risks remain skewed to the downside. Of course, we consider further waves, and we've seen already news of the Omicron variant. So with further waves of the virus, especially during the winter period now. So the possibility that the vaccines may not protect against variants of the virus, and the lack of the progress on vaccination in many countries. As I mentioned at the start, we have seen where there is a disparity between the uptake of vaccine in the advanced world versus those in the emerging world. We include a fan chart from a stochastic simulation of our NIESR model, which we look at possible effects of a further wave of the virus hitting in Q4 of this year against the likelihood of stronger GDP growth, mainly driven by pro-cyclical fiscal and monetary policy. We also now see greater risk of higher inflation. So a tightening cycle in advanced economies might create adverse financial market effects on emerging economies, especially those with high external debt and, of course, expected lower growth, leaving those economies exposed to financial market stress should investors' risk appetite reverse. And finally, the vulnerability to future negative shocks is also another risk. For instance, while higher public indebtedness does not constitute a problem for now, if consumer price inflation were to remain quite high in the future, then debt sustainability might be affected by higher inflationary expectations and increased market interest rates. So just to sort of to sum up, as I said, the global economic recovery is expected to continue, but at a slower pace. And the most obvious sign of economic dislocation is to be found in the worrying escalation of inflation. And we still see some big risks to our forecast, particularly a further wave, as I had mentioned before. And I'll just leave you here with a sort of summary of our forecast tables, and I will hand over to my colleague Arnab, who will speak to us on the regional outlook. Thank you.
Thank you, Kamar. And good morning, everyone. Let me try and share my screen. Sorry, it took me a few minutes to get the right buttons pressed. Thank you, everyone. Thank you, friends, for joining us. It is an exciting day today, but against a grim context of uncertainties and steep economic downturn brought about by COVID, and then continued uncertainties of the Brexit process. So the ongoing aftershocks of COVID, it will come as no supply to any of us, together with supply chain disruptions and uncertainty over the Brexit deal. They continue to ravage through the British society and economy, and with diverging consequences across the devolved nations of the United Kingdom, across English regions, and to devastating effects upon certain segments of the population. So against the backdrop of the autumn budget and spending review, together with uneven progress in monetary, fiscal, and regional policy, we will bring quite depressing projections for the UK as a whole, a little bit, I'm going to talk a little bit about the UK as a whole, but focus more on regional projections of distributional inequalities moving forward. But that is, while that is the depressing part of the story, there is a positive story to say as well. And I'm going to come to that in a few minutes. Today is quite an exciting day. But the overall prognosis, our overall prognosis is what is, kind of summarized here. So the stuttering recovery, supply chain issues, which are magnified by Brexit. Regional regeneration is a big question mark. And the policy choices interact very strongly with poverty, which is a cause of concern. And one of the things that we are therefore focusing on is rethinking the monetary fiscal mix, but also to look more exclusively at regional policy. So in terms of growth, this is across the whole of the UK. The best period we have already passed, following the sharp downturn in 2020, growth in 2021 is 6.9%, but what comes next is 4.7% growth in 2022, 1.7 in 2023. These are our projections, and then around trend of 1.25%, which is not very high. So we are staying substantially away from the steady state path of well-being or economic output in the peak pandemic times. Now, there are some critical judgments here in our view of where we are going to be. One is a squeeze in real wages, together with lower universal credit rates and higher inflation. Then this implies that consumption, to support consumption, savings will fall sharply. So that's an aggregate view. And in terms of inflation, the worst is yet to come. Actually, we are forecasting what's inflation outcomes in 2022 compared to the Bank of England. And so we suspect that inflation will shoot up and hover around 3 to 4%, and then go back to a steady state target around 2%. In fact, we think that the Bank of England's current forecast in 2023, there is only 30% chance of that being achieved. So overall, growth risks are down, but inflation risks are up. But then that is, of course, conditioned on the progress of our recovery against the virus itself. So, so there's a substantial uncertainty here. So that is the aggregate view. So growth slows quickly, inflation peaks April, then declines. We think that against this backdrop, the policy mix has not been particularly helpful. So fiscal policy should have been more supportive for a longer period of time, and the measures brought in by the Chancellor at the current budget and spending review, but also previously with the withdrawal of the furlough, could have been continued a bit longer, whereas monetary policy should have been tightened earlier to leave space for monetary policy to be more effective in the future. So Bank of England is late in the game. We think policy mix is wrong. This is not the only policy mix which is wrong. The bigger question mark lies around regional policy, and we are going to come back to that in a bit. And finally, there are asymmetric risks, and they are things that we are watching quite closely. Now, against that depressing broad outlook, let me bring you a little bit of a good story in the context of UK regional outlook. And that good story is this wonderful NIESR University of Glasgow partnership that we are sort of launching today out to the general public out there. It has been there for a while now, so we have been working towards it. So where do we come from? So aggregate UK views you would all appreciate, they tell us little about prospects and policies appropriate for the devolved nations and for the English regions for that matter. And this is particularly important in a country like the United Kingdom, which has been described variously as hub no spokes. So there's a hub in London, but not sufficient connections to the rest of the country. Two-paced economy, one might even say multi-paced economy. We're going to give you some instances of this as we move forward. The distribution of poor households in the country as a whole are highly clustered, and there are persistent deprivation and destitution amongst some. So there was felt an urgent need for regional models and analysis specific to Scotland and its regions. And in this context, this partnership came along. So we went into a partnership. We are very happy to go into a partnership with the University of Glasgow. And there are two things that we are doing. Of course, we are building a narrative around the Scottish experience of the pandemic and recovery from the pandemic, the Brexit process, so on and so forth. But behind this, there's some technical work going on as well. And two things are happening there. One is we are developing a Scottish macroeconometric model. So in the same way as Kemar just described the global macroeconometric model and UK sitting as a part of it, similarly, we are now thinking of building a model, or we are in the process of building a model, which is the UK model as a whole, but within that, the different devolved nations and regions sit within that. That is one part of it. The second one, which is NIREMS, the National Institute Regional Modeling System, which is what I'm going to talk about a bit more today. So what is NIREMS? It is something which is has enabled us since the start of the COVID crisis to provide projections of UK regional performance. It is basically an advanced evidence-based modeling system. It is inclusive in the sense that it is inclusive of all segments of society and all regions of the country. And in some ways, it is Oracle because it can do a lot of things and ubiquitous. So it is structural because it is integrated with NIESR's global macroeconomic model, macroeconometric model, NIGEM, the National Institute Global Econometric Model. At the same time, it is micro-founded because it is based on household data and NIESR's micro-simulation model, Linda, and it is integrated with NIESR's dynamic sectoral model. It is scalable. It is currently implemented at UK NUTS 1 level, so government office regions, including the devolved nations, but one can go down to city region level, and that is what we are trying to do at the moment. It allows for two kinds of spatio-temporal dynamics, both the effects of global shocks like COVID, like Brexit, so on and so forth, but also local spillovers. What happens when there's a third runway in Heathrow going forward, whereas the plans for the extension of HS2 to Leeds seems to have been scrapped, and similarly, the bridge or tunnel link between Scotland and Northern Ireland appears to have been scrapped as well. So those are the kinds of questions that we are looking to answer increasingly with this kind of model. And it is obviously adapted to current new generation big data machine learning technology. Now, what do we get from here? Well, essentially for our prognosis moving forward in the medium to long run, we see regional disparities widening, notably in Northern Ireland, but also in parts of the South and East and the Midlands. And the incomes of the poorer households is being squeezed without universal credit or another policy. The levels of destitution will double. And therefore, we need an institutional policy framework to support local firms and households living in local places to do better. So support local firms in creating better jobs, provide the skills that are needed, and we need local delivery and accountability. Now, looking at regional imbalances in output as measured by gross value added, we find that all devolved nations and English regions, they would recover to pre-pandemic levels in 2022. Well, this is except Scotland, where the recovery happens a bit earlier. Actually, it happens in Q4 of 2021. And one of the major reasons for that is Scotland is a big beneficiary of the travel opening up and hospitality industry, particularly surrounding COP26. However, in the absence of broader institutional momentum to take positives from this and move forward, we think that the positive effects of that would be transitory. So beyond that, pace of recovery widely varies across the regions along familiar and entrenched patterns. London recovers quickest, followed by Midlands and South and East, while recovery in the devolved nations as well as the North lag behind. Similar regional trends also apply to employment, where the general pattern is broken somewhat by gradual lifting of travel restrictions and the COP26 summit. As I mentioned earlier, you can see here that there is a peak in employment in Scotland in 2021. This, we think, is because of the relaxing of travel restrictions on COP26. However, it falls back very quickly because there is no institutional mechanism, appropriate institutional mechanism to take the positives and put them in the bag. So Northern Ireland, parts of the East Midlands and Southeast, they bear the cost also of uneven Brexit transitions and supply chain disruptions. The huge interregional differences, disparities are perhaps best seen in productivity, and this is well known, where only in London, amongst all regions of the UK, do you have substantially, productivity levels which look more like what should happen to G7, G20 countries and so on and so forth, whereas everywhere else lags behind. Scotland does slightly better perhaps than other regions and devolved nations of the United Kingdom, but the difference with London is stark. So the two-paced economy marches on. The North and the Midlands, and particularly Wales, lag behind quite a bit in this respect. Now, these broad regional patterns impact unevenly upon the population. To understand better the impact of COVID and welfare policy responses, we conduct a counterfactual exercise where we plot several things. We plot the distribution of expected household consumption in 22 to 23. That is in the red line here, this red line, okay? Right? We plot that against two things. One is what would have happened if there was no COVID, that is the black line here. And what would have happened if the universal credit uplift would have continued for another year or so, that is the gray line here. What do we observe? We observe that across all quantiles, the entire distribution of households, consumption is squeezed as a result of COVID. That is no surprise, right? So the red line is always to the left of the blue lines, consumption is squeezed. Okay, the biggest squeeze comes in these two regions, the region A, which is of middle income households, which face permanent scoring, and this is not going to go away very quickly unless we can combine this with measures to enhance consumption for these households, particularly maybe even green consumption, investments in new green products and so on and so forth, cars, upgradation of housing, so on and so forth. So we need urgent policy here. But most importantly, it is this region B of poorer households which are really pushed to the margin of destitution. Particularly, see the steepness of the curve here, which shows that the margin of destitution is actually very acute here. And there are many households which have been pushed right to the margin. Now, for these households, half of the effect of COVID would have been taken away by universal credit uplift continuing for another year. And it would have cost the exchequer less than 5% of the total welfare budget to do that. But unfortunately, they have decided against it. So these households are left at a large. We argue that the enhancement of minimum wage and the taper rate, they benefit a slightly different segment of the population. And while they are welcome, there needs to be more support for the poorest in society. One outcome of this is, of course, that the regional distribution of destitution is quite remarkable, with devastating effects clearly concentrating upon certain regions, and particularly northwest of England. More analysis can be found in the regional chapter of the Outlook, but let me now turn to some policy measures, and some of these are going to be slightly controversial, and maybe it will generate some debate and around the process of politics moving forward as well. So one of the things for regional generation, what we suggest, and this is not a suggestion which has been made that much in the literature, is that one needs to work with the capital markets. So faced with over-centralized capital markets, can we now start thinking of creating regional and sectoral banks, which would be encouraged to lend within areas and within sectors, within particular regions and sectors, maybe even expand the remit of the National Infrastructure Bank to a National Investment Bank. So these are questions that we would like to ask. An important question here is, of course, the skills mismatch. A lot of people have, have faced unemployment. They have gone out of the labor force, even gone out of the labor force. So this disaffected, workers, they need to be brought back in, and therefore we need a policy of that ties in jobs and skills more explicitly. On the skills mismatch, we suggest building better partnerships between higher education and further education institutions to foster hybrid skills. We don't think the chancellor's measures in the budget go far enough. We propose measures to bring together business, trade unions, and local government to provide significantly more apprenticeships and create more vocational entry opportunities to the labor market, particularly in areas where there are skill shortages. Finally, on the question of local government, we have quite a bit to say. Please read the Outlook, and we have a lot more discussion there. But what we suggest is on policy design and delivery, we think there is an urgent need to empower local government. We need to boost capacity by providing revenue streams which are not directly controlled by Her Majesty's Treasury. And this would strengthen ability to adapt to local requirements, for long-term investment, and build up strategic capacity to link issues of infrastructure to the key social issues of education, housing, training, so on and so forth. Ultimately, enhance accountability of local governments to their citizens and not simply to the central government. And with those, I leave you with a summary. Regional disparities are widening, where the poorest households risk sliding into destitution. Here, we think that both our own national history and international comparison can provide examples of how regional regeneration can be done. In the Outlook, we talk about the German experience in more detail, long-term strategy at appropriate level and scale, and local and regional capacity to design and deliver. Thank you very much. I hand you over to Graham now.
Great, thank you very much, Anab and Kumar. That's fascinating insights. So what I'd like to do next before we open it up to the questions is to ask Professor Ron MacDonald from the University of Glasgow to give his reflections on the Outlook, but also perhaps kind of his reflections of what that means in a Scottish context too. And then we'll open it up for questions across the team. So if you could maybe if you're thinking of a question, a really killer question that you want to put to Arnab or Kimar or Ronnie, then if you type it into the Q&A function just now, then we'll get around to it. But Ronnie, it'd be really interesting just to get your reflections on what you've heard and what do you think that means from a Scottish perspective.
Yeah, thanks very much, Graham, and thanks for inviting me today. I think it's, as Arnab said, this is a very important initiative that we're embarking on, particularly given Scotland's place in terms of its devolution journey, but also in terms potentially of its contribution to net zero, I think, and that's something perhaps we can say a bit more about going forward. Just reflecting on what we've heard, I think the Scottish context, if you look at the most recent Scottish Government Economic Report, a lot of what's happening here is broadly similar, I think, in terms of the projections for GDP. I mean, if you look at the Fiscal Commission's projections for GDP going forward, they're almost the same as what Arnab had on the screen a few minutes ago. The main, and also I think if you look at scarring, for example, in terms of the hit to potential GDP, that is about the same in terms of about 2% going forward. I think where the differences come, obviously, are in the differences in the structure of the Scottish economy, and as Arnab picked up there with respect to the recovery in Scotland being earlier than the rest of the UK because of the hospitality sector, obviously that has had a big impact during the pandemic, and it's interesting to see how quickly we've caught up when restrictions have been eased. But I think there's an interesting issue there in terms of the diversification of the Scottish economy, because clearly we took a big hit because of what I could call maybe the disproportionate effect of hospitality in the Scottish economy. And maybe how do we address that going forward? Personally, I think one area that we can address is that the pandemic's given us a great opportunity, I think, for people to live and work in rural areas, which have been traditionally quite deprived areas, as Arnab was alluding to there, and there's inequality. But also there are areas in Scotland where people have been migrating away from these areas, but they are wonderful places to live and work. So I think there are opportunities in that direction. Perhaps I could just say a couple of things about maybe causes for concern in the Scottish economy. One of them, interestingly, was the point that Arnab made about productivity, although we're by no means the worst performing area in the UK. It is still not comparable with, obviously, the London and the Southeast. And that shows up also if you look at GDP per capita from 2014. In the UK, that's grown by about 8%, whereas in Scotland, it's just under 3%. So that for me reinforces that there is something happening there. Now, part of that something that's happening is probably to do with the decline in the North Sea oil sector. Obviously, the size of the North Sea oil sector is less than it was previously, but and it's less important, obviously. But nonetheless, if you look at the Scottish value export figures, they are significantly down this year, and a good chunk of that is due to the contribution of oil revenues. So I think there's a big issue there about how we replace the North Sea basin going forward. And I think there's an interesting discussion there with respect to the hydrogen economy. I think there could be I think there's a huge benefit for Scotland in investing in the green economy. It's something that's mentioned in the NIESR report. In a UK context, will the UK will be able to use its fiscal capacity to invest in net zero? Same question applies in Scotland. And I guess there are issues there relating to how we create fiscal capacity in Scotland. And, I know there's work being done, and I think you're involved in that, Graham, in rethinking the fiscal framework. So I think that's going to be very important going forward as well. The other thing I'd mention, which is a bit of a worry in a Scottish context, is that our business investment is still significantly below pre-pandemic levels, and that's clearly a worry in terms of if you combine that with the demand fall coming from net exports, then how are we going to compensate for that? Especially, I suppose, given our inability to have much fiscal space at the moment, given borrowing constraints that the Scottish government has. So, well, I've probably said enough at this stage to get things moving there.
So, Ronnie, if we ask you just your point about the oil and gas, so the immediacy of the decline there, and then the opportunities about flipping into green technologies, how, in the work that you've done, I mean, in terms of the timing of all of this, how pivotal are the next, say, 3 to 5 years in the ability to flip from one energy source into the opportunities in hydrogen? So I know you've spoken a lot about the potential opportunities for Scotland in hydrogen. How quickly would they come on stream? Would that be something that could be invested in now and could create jobs, or is it very much a long-term play?
No, I think now is the time to be investing in R&D, particularly in green energy, in terms of how we store green energy, how we transmit green energy, how we actually use green energy in terms of, for example, cell technology. So I think it is important, though, that the Scottish government do take the lead in this and show how we can build a world-beating energy sector again, as we did in the past. And I think one crucial aspect of this is that we must not lose the talent and expertise that we have in oil, because a lot of that is clearly transferable into, for example, the hydrogen economy, because we can potentially reuse a lot of the networks that have been created in the North Sea sector, for example, to store hydrogen, to produce hydrogen, obviously from green sources in terms of wind turbines at sea, and also obviously on land. And so the point I'm always keen to stress is that we have to be ahead of the curve. We don't want to be followers in terms of this, and we've seen that in the past in terms of the actual infrastructure, the wind turbines being built overseas, and we lose out of this because of procurement policies, for example. We have to sort these kind of issues out, I think, and start investing now for the future if we are to be a world leader, because it's obviously not just the production of hydrogen that's important. It is important because it is a tradable commodity and could potentially replace oil as a major export for not only Scotland but the rest of the UK. But it's important that we're leaders in this technology so that we capture the really high technology aspect of the green sector.
Great. Well, maybe if I could ask Arnab and Kimar to come back on screen and we can kick off a broader conversation. So we've got quite a few people who are on the call today. So if there's any questions, please fire them into the Q&A chat and we will try to get through as many as possible. But I mean, one first question maybe for Arnab, and it just picks up on something that Ronnie was saying around regional inequalities in Scotland and the potential for the post-pandemic world to look at these again and to think about the opportunities that come with that. But there's obviously inequalities within regions just as much as inequalities between regions. So I was going to ask, what are your views on the ability, the opportunities to tackle these inequalities within regions, but also maybe just give an update on where you are in your thinking at the National Institute about modelling those more granular local data and local areas beyond the regional elements that you've done so far.
Thank you, Graham. This is very much at the forefront of how we are thinking about regional regeneration at the National Institute. But before I go into a bit more Scottish context, perhaps, let me invite Adrian Pabst, Deputy Director for Public Policy at the National Institute, to perhaps give us a broader view on this, as Deputy Director, but also as a political scientist. Adrian.
Thank you so much, Graham and Arnab, and of course also Kema and Ronnie for the fascinating presentations. So what we're trying to do, which Arnab has already talked about, is we're really trying to connect the different models we have, so that rather than just talking about, an aggregate picture, whether at the international or national level, and then separately the regional level, we're really trying to link up all the models. So the global one feeds into the one about the UK outlook, and then into the regional one. But also we have a sectoral model that Arnab mentioned, as well as a household model. And really what we're trying to do is go to ever more granular levels, so that we understand, for instance, how a family in Glasgow or in Aberdeen or in other parts, is affected by the various shocks. Now, we aren't quite there yet, but that's certainly the trajectory, that we want to be able to say how households, sectors and regions fare in this national and indeed international economy we're living in. The other thing to say is that, our work very much focuses on both the economic and the social aspects. So yes, of course, we're interested in the economic indicators that shape people's incomes, whether it's growth or productivity and other factors, but also, how are life chances affected? So what does it mean for the social well-being, right? And so we're very interested in connecting those things as well. And perhaps very briefly, where we want to go is really towards the idea of a dashboard for regional regeneration that will then tell us exactly what's going on in different parts of the country at quite granular levels, but also a dashboard that enables us to model the impact of policies. So if, for instance, universal credit had been extended, what would be the impact? Now, that's work we can already do. But if we're thinking now of skills policies or R&D, as Ronnie mentioned, or other interventions, what would it mean for economic and social development if certain policies were adopted? So that's sort of the destination really, or rather for the moment, the kind of work we're undertaking, and very much with a focus on developing better models for the different parts, for the Scottish economy, for the Welsh one. We're also working with ESRI in Ireland to work both on, the whole island of Ireland, but then also Northern Ireland in particular. So, these are some of the things we're trying to do. And I think the key is not to fall into silos and say we're only going to look at one sector or one bit of the economy, really to try and have a more holistic picture, whilst also being very granular. And that means we can only do this work with regional partners like Glasgow, who are both regional partners because, of course, where they are, but also have a national, international outlook. So it kind of then joins exactly the work we want to do, right? And if we have more partnerships like this around the country, we feel there's going to be a more accurate reflection of the picture that effectively people experience where they are.
Mm-hmm. That's great. Thanks, Adrian. It sounds really exciting piece of work. So yeah, Arnab, on the actual data and the things you've found so far.
So two things. On the data, the dashboard is very important. So what we're trying to do is to create a dashboard where we can go down, at least to put on the table all information that we have in one place, right? So that itself is a good start, because at the moment regional data are scattered everywhere, right? So that needs to be, we need to start there. And to broaden the discussion a little bit means so I wear two hats here. I also wear the Heriot-Watt hat. So Heriot-Watt also made a submission to the Scottish government's 10-year strategic plan for economic development and economic restructuring. So two things come out of that, I think, which are quite important here. So the first one is that in terms of developing the interregional equality in agenda of interregional equality within Scotland, we need to make sure that Scotland is very good in developing new knowledge and technology, but has not been very good in retaining the fruits of that within the country itself, and that is something where we think the government can do a lot, and we can potentially help the government try and see how to do this. And so that is one thing. And similarly, Ronnie mentioned the North Sea oil and so on and so forth. Much of the returns of this go straight out of the country, go straight out to London and then onwards. So there must be a way through the fiscal consolidation within the the devolved nation of Scotland itself to try and divert at least part of this to the Highlands and Islands and other places which might be needing and which might benefit more from a little bit more impetus. And that is also something that we have very much in mind. Together with this, there's the question of greater fiscal powers to try and do that. And so all of these things work together. Now, how do we make sense of this? The first thing that we want to do is to try and create a dashboard where we have all the data in place, and then slowly start looking at different problems and try to see what kind of policy solutions we can provide. So that's a kind of, we are on the edge of the iceberg. Really, we are trying to sift through, and together with all hands on board. This is not a me task. We will try and get somewhat more in that domain. Thank you.
Great, thanks, Anna. So a question for you, Kumar, about the global outlook for inflation and what that means in the UK context. So you talked in your presentation about the different drivers of global inflation and what's making it so spiky at the moment. And Arnab talked about the outlook in the UK context. And I was just wondering whether one of the phenomena that we're seeing in the UK at the moment is around the sharp rise in vacancies and the disconnect between vacancies and unemployment, and has the beverage curve shifted out, or is it where it should be? It'd be interesting to get your reflections on where the global inflation outlook is. So is that being driven by the same issues around vacancies, or is it being driven by other effects on blockages in supply chains? Has it been driven by other effects in terms of energy prices? But useful is a question about what is driving global inflation?
Yeah, thanks, Graham. That's a very good question. And as you rightly said, or suggested in your question, what's driving global inflation is the myriad of factors, really. One of the key things that we look at is a sort of how low inflation was last year. So what we look at is what we sort of call the base effect. So we started at a low inflation last year, so we've seen like higher inflation coming around this time around, and we're seeing this in a lot of economies, particularly in advanced economies, and as you rightly suggest, supply chain disruptions, rise in the price of raw materials and stuff like that are contributing to higher inflation that we're seeing and on the global scale. Now, one thing that we're sort of looking at, or one important aspect to consider, is whether this inflation will be temporary or not, because this will obviously determine how the sort of recovery we are seeing in these economies, how that develops. Because of course now, as we can see with inflation overshooting in the UK, for example, like you mentioned before, we expect at some point the Bank of England will sort of dial back on monetary policy accommodation. So a lot will depend, of course, also on how much spare capacity there is in these countries, and of course how wages react in that manner. So it's all of these combined will determine well is first contributing to the level of inflation we see now, but how also the sort of policy reaction that we expect to see.
Yeah, no, that's great, thanks. And a question for you, Ronnie, about investor certainty and confidence. So if we're shifting into things like hydrogen, we need to have clearly investor confidence and certainty over the long term. How attractive do you think Scotland is as a market for long-term investment in these initiatives, such as whether it be hydrogen or whether it be any green investment where you're investing in over 5, 10, 15, 20 years? Do you think that's a comparative advantage for Scotland, or do you think some challenges there?
I definitely think a good comparative advantage. We already have that, I think, in terms of producing green hydrogen, because we've got a wealth of renewable energy capacity already, and future capacity is almost unlimited, I think, for the production of renewable hydrogen. And I think your point links, to give certainty, I think it links into a couple of things Arnab said there. I really do think we need more decentralization to local authorities and a rethinking of our local authorities, particularly in Highland. I think that's very important. And also, I really favour the idea of a public banks, which Arnaud mentioned. I also argued for that in the Policy Scotland paper earlier this year. And it's very interesting. This links to the centralisation point, because Highlands and Islands Enterprise, which is some of you may not be aware of this, but it is a quango in the Highlands and Islands. And traditionally, they acted as a public bank, but because of centralisation, the resources have increasingly been cut back and taken back to the centre. So I think if you had outfits like HI being able to disperse funding, because they know the local markets, they know the people who are going to be investing, they know if the investment is going to be sound, I think that would give a lot of the certainty that you mentioned, Graham, into the picture, and I think it would be really important in enabling us to take this forward.
That's a very good point. It's the next big policy thing that we're going to get over the next few weeks is the UK government's white paper on levelling up, and we've got about 3 minutes left. So it'd be really good to get your take, particularly colleagues at National Institute, and then Ronnie too as well. How hopeful are you of the UK being able to level up itself? So maybe I'll come to Ronnie first, just to give our colleagues in the National Institute time to think, because you'll have to, I know you've done some work on this before, but Ronnie, how confident can you be that we can level up an economy such as Scotland or the UK?
Well, I suppose you've caught me on the hop a bit. But I suppose going back to the whole renewable initiative and thinking about that, there is, as we've heard, surrounding COP26, a huge amount of private sector finance available. And so I think if public sector finance were to be targeted, as I was saying earlier, in specific areas, we may stand a very good chance of being able to level up if it would attract in some of these green funds that we're told are out there and are ready to mobilise. Yeah. So it perhaps is possible, but it does need the initiative, I think, to come from government first of all.
Yeah, great. Okay, so whoever NIESR colleagues wants to take on the grasp the thistle around levelling up. So Adrian, you've muted yourself, whether accidentally or on purpose, but because you've done that, I'll come to you. So.
Yeah, no, I did do it on purpose, and I think what I think gives me hope is that now there is both a recognition of how bad the imbalances are, and I think some ambitious thinking around these questions. You know, whether it's across government or indeed, amongst policymakers and researchers. But I think levelling up will take so much more than a white paper and some funds, right? You're not going to solve this by throwing some money at it in the short or medium term. What you really need to do is you need to have a longer term plan as well as short term delivery. You need to have it at scale, as we said, and you need to build institutions that can sustain this above and beyond any one political or electoral cycle. This is a generational task. And therefore, it requires the right institutions, the right long-term thinking, so that it can be done over, a generation and not just over 2 or 3 years in order to win the next election.
Yeah, no, that's a very good point. And I think that's where, again, coming back to the comments we had at the start about the importance of this partnership and the importance of what you and NIESR are doing around linking up with ourselves in Scotland, but also in Cardiff with colleagues to better understand the local policy context, the local economic situation, how that can then form high quality analysis and recommendations from an academic and impartial perspective about what policy changes can have the greatest impact. I'm conscious of time and we've used up our full hour. So it leaves me to thank Adrian, Kimar, Arnab, Ronnie for their insights and thoughts for today. We will be recording it. We've been recording this session, so we'll post the session online so you can watch it back. As mentioned, this is part of the ESRC's Festival of Social Sciences, but it's not a one-off event. This will be a regular occurrence over the next few years as we continue this relationship and continue this work. And in time, hopefully, we're also keen to be doing events looking at the regions across the UK. So with colleagues in England, Cardiff, Northern Ireland and Scotland too. So please stay tuned for those developments. And there will be an evaluation form as part of the SRC's Festival of Social Science pinging its way to you. We'd be very grateful if you could fill that in. And we look forward to seeing you all very soon at the next one of these NIESR and University of Glasgow webinars. Bye for now.
Thank you. Bye.
Thanks.